Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, the 22nd of October. A sharp pullback in gold and silver prices marked Tuesday's trading session as oil rebounded, the US dollar recovered, and the US 10-year yield slipped below the 4% mark. All the things that you would not expect to happen during a US government shutdown, right? Meanwhile, earnings from the biggest US companies looked quite encouraging to say the least, and short sellers out there are now rushing toward the exit door into next week's much expected Federal Reserve rate cut decision. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So it just took a few hours for gold and silver bulls to take their profit in their pockets and move to the sidelines yesterday, leading to the biggest price pullback across both precious metals prices. Gold fell more than 5% in a single session and silver tumbled nearly 7% yesterday. The sell-off actually continued in early hours of Asian trading session today before the buyers kicked in. So for gold, we saw a quick rebound this morning approaching the $4,000 psychological mark, while silver saw demand near the $47.5 per ounce level. Now, why precious metals sold off yesterday this rapidly and whether this is the beginning of a broader price pullback in this market is yet to be seen. But looking at yesterday's price action, the pullback looks like it has been mostly triggered by hope of easing trade tensions between the US and China this week, and also a rebound that we saw in the US dollar. But trade tensions are not guaranteed to ease for good, at least not this week, and probably not during Donald Trump's entire mandate at the White House. And while the US dollar's rebound yesterday may actually be quickly reversed with persistent and very much alive dovish Federal Reserve expectations. Plus, remember that the US government remains shut and the debt worries in Western world have not eased at all. On the contrary, French debt was just downgraded last Friday, and the divided French government there makes any budget deal look like terribly complex and complicated. The UK, on the other hand, just printed its second biggest borrowing for April to September period since the data collection began in 1993, and the other one, so the biggest one, was during the pandemic months. While in Japan, well, they just appointed Takaichi as their next prime minister, and she is willing to expand the government spending to boost growth in Japan. So what probably really triggered yesterday's precious metal sell-off was the fact that the metals are now trading in deeply overbought market conditions, and anything could trigger a sharp price move with this heightened volatility, as we discussed broadly in yesterday's Market Talk episode. So the gold volatility index here has actually spiked this October to the highest levels that we saw since March 2022. And as I said yesterday, if history is any guidance, gold had retreated 20% at that time following that volatility spike. So given the latest euphoria around gold, crowded speculative long positions in the gold market, and overbought market conditions, a further pullback in gold prices and silver prices is well possible without, however, threatening gold's, for example, value in longer horizon portfolios, because gold has actually become the go-to asset for global investors, from retail to institutional and central banks that actually try to protect themselves from sovereign debt worries of the moment, trade and geopolitical jitters, and also the inflationary pressures. So those factors have actually become the reality of today, and they are not going to change overnight. So some see the price pullback in precious metals as opportunity to strengthen their long positions. Now, while gold and silver bulls were having quite a hard time yesterday with that heavy sell-off, oil traders actually breathed a sigh of relief with a more than 1% rebound in US crude prices yesterday, followed by another 1.20% gain in Asia this morning. But here we have the opposite scenario unfolding because oil has actually fallen near oversold market territory on murky global demand outlooks and ample OPEC supply this year that is now expected to lead to a supply glut later this year. And while the soft US dollar that actually improves EM demand for energy and prospects of Federal Reserve rate cuts couldn't improve appetite in crude since the summer, as it was expected to previously, while cheapening oil could eventually improve appetite for the US 10-year paper, according to Ed Yardani's research, because Ed Yardani actually argues that cheaper oil could tame inflationary pressures and justify lower Federal Reserve rates and lead to a retreat of the 10-year yield to 3.75%, and lower yields should also throw a floor under the oil sell-off. So a fair to be followed here. While the US 10-year yield fell below 4% mark yesterday, mind you, and the US dollar strengthened despite the US government shutdown story since weeks, that obviously doesn't fundamentally come as good news for US spending. So go figure what's happening there. But the US dollar was up over the past days, but it's offered this morning as the euro dollar meets support near the 116 mark, which, by the way, is technically insignificant level and wouldn't necessarily hold the euro dollar bears back from further selling. The dollar yen, on the other hand, also retreats this morning from above the 152 level, which is equally insignificant level from a technical perspective, mind you, apart from being a round number. So with the French downgrade story and Japanese Takaichi trade already being mostly factored in, the next direction FX majors will likely depend on the US dollar. And that will most likely depend on the CPI figures from the United States that are due to be released this Friday, so fingers crossed. Now, the good news is that the earnings from the US are coming in quite nicely to keep appetite in stock markets quite sweet, mind you, and there are actually signs that investors out there are preparing for further Fed dovishness by exiting their short positions. So, speaking of earnings, Coca-Cola actually printed better than expected quarterly results yesterday, and General Motors raised its full-year profit target as they now trim their struggling EV business and rather concentrate on their money-making gas-powered models in an environment where climate concerns and climate regulations are obviously being out of the window. Plus, they now think that the tariffs impact from Donald Trump's tariffs will be $500 million less than they previously expected and penciled in. Then, Zions Bancorp, which was, remember, part of last week's bad loan stress story, actually topped its profit estimates despite the $50 million worth of a loss for an alleged fraud, and gave a certain relief to risk takers. Then Netflix disappointed after the bell yesterday and tanked 6.5% in the after-hours trading, but the disappointment at Netflix was mostly due to a tax dispute, without which the results would have been, well, pretty much in line with market expectations. And finally, Tesla and IBM are due to announce their quarterly earnings later today. So we'll be watching these earnings. And speaking of short positions in the market, they are being actually closed into next week's much expected Federal Reserve rate cut. Well, Beyond Meat, which is one of the most shorted stocks out in the market, actually jumped around 127% on Friday and another 146% yesterday. Now, yesterday's rally at Beyond Meat was also due to the announcement of their US distribution with Walmart, which is obviously good news for a company like Beyond Meat, but other heavily shorted names as Krispy Kreme, for example, and 1-800-Flowers.com also jumped more than 10% each. So, a fear to be fellow, to be honest with you. If we see that, that means that risk appetite is being quite strong, and we can see that appetite will further support the risk assets. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.